Thursday, we had a massive shift in the market, something you have not seen in about 20 years. And it all started here on CPI, and we're going to get into why it happened, what sectors you should be looking at, specifically what stocks you should be looking at, and how you should be trading this, and then how you can sort all this by relative performance. And there's a big data point economically next week you're going to have to pay attention to. But let's get to it. So CPI comes out, and then this happens. And what is this? This is RTY, and this is basically the Russell and futures market. And then at the same time that happens, you start seeing the ES start to drop. Why does the ES drop, and then why does it start to rally? There's several sectors in here that could actually benefit by what made the ES rally was the same thing that made RTY rally. You could make that argument. I'm not buying that argument, and we'll get into it, and you'll see why. There's a really important distinction here. There are certain sectors here that's going to make ES rally, RTY rallies, but not at the same level. And it's really important to get this distinction and what subsets are actually in RTY that are driving this. And we're going to spend a lot of time focused on that and what the driver was and how you can make sure that this driver, is it going to stay here or is it going to fizzle? The last thing you want to do is get in something that looks like it's going to do this, and then all of a sudden it starts to do this again and then go nowhere, which has really been what the Russell's been doing for some time. That's really not where this is going, in my opinion. You can also see how the NASDAQ is just the least performance of all of them. And then we have the sell at the end of the day. And we got to talk about what this means and is it something you should be concerned about? But most important is the divergence that we saw and why we're seeing this divergence. I think it's really important to understand how this data completely changed what's going on in our markets. People look at this data and they don't really understand the numbers. They watch the data move the markets up and down. But when you see a data point that says, yes, we're going to ease, meaning they're going to cut rates, well, now the question is it cut like this or are they going to cut like this? And we can dive into these numbers and we can explain why, and then we can show you how you should be trading it. Let's get to it. One of the comments I get a lot is after I show a bunch of data, people saying, okay, great. Now, how does that help me? Or what does that mean? Or he didn't tell me what that means. I present a lot of information, education, and I look at things differently. A lot of that comes from how I view the world of trading, which is really that stool, which you have the macro leg, the fundamental leg, and the technical leg, right? And then, of course, you have the top of it, pardon my voice, how it all connects. Now, why is this important? It's important so that you understand why I care about CPI or PPI, why I care about unemployment. I mean, nobody wants anybody not to have a job. But why is this so important to us as traders, as investors? Why does all this stuff matter? The best way for me to explain it is it affects profit. And if it affects profit, it affects earnings. And if it affects earnings, then it's going to affect the EPS and the PE of the S&P. And then you'll see a contraction of PE or an expansion of PE. And then that contraction and expansion of PE then ties into where's the 10-year at, right? So you constantly have all these different parts that are playing together over and over and over again. And it's our job as traders to constantly stay on top of that. It's really important to just get the concept as to why you care. I don't care to the level that you care, but if you're playing a game and somebody's playing by a set of rules and you don't even understand what the rules are, how can you compete? And once again, you'd say, well, retail doesn't look at this stuff. Well, that's why retail gets crushed. There are three major sectors of investors that I like to compartmentalize them. You have your insiders and you have your institutions, and then you have sectors of those institutions where you have your hedge funds, but really the pension managers, and then you have retail. So you want to know what these guys are thinking. We don't really care what retail's thinking. Retail in general is reactive. The other two are very proactive. So what I'm about to show you is going to explain why you're going to care about CPI, PPI, why the data coming out this week is so important. So you might want to watch this part a couple times, but I really think it's going to be worth your while to understand this and at least have a basic knowledge. We're going to go broad with this. We're not going to go too deep, but we're going to go broad so that at least you can get a semblance of how this plays out. Now, the information I'm about to present is from a research firm called Mizuho, and they do a really good job explaining why you should care about it. Weakening inflation bodes well for the Fed to begin the easing cycle. So in other words, we know that they're much closer to cutting rates because of what just happened. September and gives us the option to ease more before the end of the year. This is where it gets interesting. Softer inflation readings should finally put to rest what we think misjudged claims that inflation is sticky. So what they're saying is it's very clear that it's not as sticky as people thought, and inflation is coming down. The question now becomes, does inflation come down like this, or does inflation come down like this? And there's a big difference that affects profit. Low inflation is in line with what we normalize supply side and ongoing demand side disinflation reflects the highly restrictive monetary policy. Lower inflation is in line with the now normalized supply and ongoing demand side disinflation reflecting highly restrictive monetary policies. This is a very specific line in which they're telling you this is really becoming very restrictive to demand. And we're seeing that in the data. And I'm going to show you this so that you can see it for yourself. So when it happens in the future, you'll know what it means and you'll know why what happened on Thursday happened. Now, what happened on Thursday was way more than I thought was going to happen, certainly faster, but man plans, God laughs. So the key issue is now whether the Fed has a lot of easing to do and needs to play catch up, implying that easing will pick up momentum and be much more aggressive than currently priced. Now, what's interesting about this is this Fed is pretty much like the gang who can't shoot straight. They were buying homes by buying mortgages against us when they didn't need to. And so the idea that they're going to be ahead of a curve versus at the tail end of the curve, I believe they're going to be at the tail end of the curve. That's my opinion, and we'll go from there. But to do that, play catch, implying easing will pick up momentum and be much more aggressive than currently priced. I agree with what they're saying here. I think it's going to be way more aggressive when this starts to pick up. This will depend on the impact of weaker inflation on profits. Okay, now this is where it gets interesting because so far they haven't mentioned profits, and you're like, well, where do profits come in and why does lower inflation matter for profits? Glad you asked. If the profit growth slows to a standstill, there's a likelihood that corporates will be aggressively cost-cutting, forcing unemployment much higher. The Fed would need to take rates on the other side of neutral below 3%. Now, remember this, no one's going to fire themselves. So if a corporation starts to bleed money, the first people that go are basically the rank and file, right? It's never the C-level people that go. It's always the rank and file people. We just saw this with Boeing. This guy's making $35, $40 million a year, and the people that actually build the planes got a 1% increase. Okay, so this is just the way that it is. It's not good, but it's just the way that it is. So I think that if you realize that this could lead to more people losing their jobs, then you could see how demand could get even less. Okay, so now we understand why you care. And what we're going to look at is profit margin. Remember, PE, earnings per share. That's why we care about profit margin. And what they're doing is they're comparing that to the CPI component so you can see why it's so important. And you can see profits here in like 01, 91, 92, and look at profit margins going through the roof, even though we know that the market corrected there. And then from that point on, what happened? And you can see these periods of interest and how the easing of a company, right, by the Fed easing, when they cut rates too much, what happens to profit margins? They just explode. And we could see that here as well. Profit margins just go through the roof, and then there's a normalization. Profit margins are in blue. Then you have orange for core goods, CPI year over year, and core services year over year. Now, if you look at core goods, they've broken and you're past that zero line. So once we see the break past that zero line, we want to pay attention to that because that's not great. And if you look at this level right there, and we just do the simplest of things as draw a line from there over, what are you going to get? You're going to get, well, this is pretty bad. I mean, this is one of the levels of 03. And now what I would say is, well, how did the market do in 03? It did really well, quite frankly, if you take a look at that period in time. But what's going to happen here? Well, we're going to have to watch core services, CPI, and see if that drops. And then we're going to have to see if profit margins follow that. And then we're going to see how low this actually gets. Because from my perspective, core goods year over year CPI, and this is important. If we look at the peak, well, you already peaked. So the question is, if we're here, then this starts to drop over years. So is that what we're heading up for? And this is a really important question, and I don't have the answer to it. I'm not here to give you an answer. I'm here to tell you what to watch for next week and why you should care about it. Because when you're looking at this stuff, it's basically like trying to put a puzzle together, and all we're trying to do is put the edges on first so we can figure out the middle. Now, understand that in front of you is demand inflation, and I should have cut this out, but I don't have time to redo this. And these videos, they take a while to do, so you get that. If you find this valuable, I do appreciate you sharing these in your comments so I know how to create this. That's why I'm actually going over this before I even get to the data, because a lot of the questions are basically like, okay, boomer, but now what do I do with what you just told me? How does it affect the market? And this is how it affects the market. Now you understand, or you should have an understanding. So you sharing this, your comments, that's how I create it, but sharing it, please do that because I purposely do not run ads. And I do that on purpose because I know it's really annoying. And I just want to get this out there, but the algorithm loves that. So by you sharing that, it combats it with you seeing an ad for like, I don't know, something silly that I don't even. So anyway, here you are, real rates, and they lead by what? 6 months. Okay. And what follows? Demand inflation. And why do we care about demand inflation? Because of profit margins. All right. So we're all caught up. We understand why we looked at what we just looked at. And what they're telling you is that as real rates drop, and I'm not going to get into real rates again, we did a whole series on that, but as real rates drop, we're looking for demand inflation to follow suit. Now, if demand inflation follows suit, and look where you're at, breaking that zero line, well, this becomes a pickle because it's almost impossible for profit margins to stay healthy if this continues on the path. So they're going to have to do something. What is that something? Cut rates. And remember, this Fed doesn't work like a scalpel. They don't do a little and see how it works. They do a lot and then go, oh, how'd that go? Right? I mean, we never had cuts like they've done before. We've never had a Fed intervene like they did after the pandemic, ever. And you could argue as to why they did what they did. We could all make that argument. This is what happened. They came in heavy and then they corrected heavy without seeing what they were really doing to the market. So whenever you course correct, you're not going to just course correct and go, oh, we're going to do 1 or 2 cuts. I've been saying this for some time, that it was going to take longer than expected, but it's going to be way more than people think it is. It just has to be. And in the long run, it's good for stocks, especially with this group, because they're going to do more than they need to do. That's just what they do. But inflation and profits, the inflation squeeze should imply softer profit margins. And now you understand why. Profit margins are defined as the difference between unit prices, CPI, and unit costs, PPI. Profit margins are defined as the difference between unit prices, CPI, and unit costs, PPI. Do you understand now when we go through CPI and PPI why the differential between there is going to be so important? Let's keep going. Prices in this measure are technically from the GDP deflator, but are highly correlated with consumer prices. Thank you. We can model the profit margins growth based on core CPI components, which I showed you earlier. Based on the latest data, profits should actually be a little stronger than realized in first quarter 24, but are decidedly weakening. Yes. Based on Q2, data margin growth has slowed from 8 to 4% year over year. Based on Q2 data, margins growth has slowed from 8 to 4% year over year and are set to go to 1% as inflation meets target. Okay, this assumes unit cost inflation, CPI, is unchanged at 0.8. This suggests there is a real risk that corporates will cut costs to defend margins, prompting a rise in layoffs and unemployment. Unemployment goes higher, people buy less widgets. So now you understand why all this is very important. So the next time one of your bros asks you, oh, well, why do you care about CPI? I'm just a trader. And you're going to be like, PE. It's all about the PE. Okay. It's all going to be about profit margin. That's why you care about these numbers. Who can pay for it, who cannot. Core inflation month over month, this is what happened, actual consensus. This was actually fairly decent and shows that housing prices are coming down. Remember, housing, rents, all of that is roughly 33% of inflation, and it's even more weighted with core because remember, core takes out food and energy, and that's really important for us to remember. All right, so fast forward, where's the real issue? The real issue is here. Negative 0.1 versus 1. This is a level that we usually do not see. Now, to put this into perspective, the last time we had a number that was that low, we were right here. And the last time that we were even close to having a negative number was something with the pandemic. And since then, you have not had a negative number. That shows how severe that number was on Thursday. Now, Friday, we had month over month. So we know that CPI at all the levels of CPI, meaning core CPI and regular CPI, month over month and year over year, were either down substantially or in line. Matter of fact, they were down so much that nobody was even close to that number. No one even came close to where they were supposed to be on that number as far as an estimate. Now, month over month, okay, 0.2 versus 0.1. Core, month over month, 0.4 versus 0.2. Core PPI year over year, 3% versus 2.5%. See this huge jump in PPI. Okay, this is really important. 2.3 versus 2.6. This is the statement. I actually got this shot from Trading Economics, which is a free site. But what you can do is you can go there yourself and look all this data up. Just click on it. Now, let's look at the difference here because you're looking at core PPI, and this is final demand net of food and energy costs. rose from 3% to the previous year. This is a statement from the U.S. Department of Labor, which has been referred to. What they're doing here is how they're taking the components out. Remember, the CPI, they're trying to make this number look so good, they took coffee out, for God's sake. The result was sharply higher than the market expectations of 2.5, upwardly revised to 2.6 from the previous month. Look at what happened to make CPI drop at first. So in other words, PPI is what they pay, as we just went over. CPI is what we pay, they pay PPI. All right, this is what got CPI down before. This is what's going on with PPI. This is what got the CPI to drop before. CPI is dropping now because of profit margins. So why does this matter? This matters greatly because they mentioned in that article I just showed you that profit margins are going from that 8 level up here to a 4 level. And so that's going to drop. And they actually say, hey, you could be looking for a 1. Well, everyone keeps wondering why the S&P has only 8 or 9 stocks that have growth in it. Now you understand why. Our concern is, how high is this going to go? Because right now you're over it. Now, and no one looks at this. This is really important. No one understands this stuff the way that I'm explaining it. Institutions do, but when you get to retail, they're not paying attention to this stuff. And this is when they get clobbered some days. But if you look at this here and you go over here and go, well, what are they really doing? Like what is really happening here, right? And this is one of the reasons why I think you're seeing gold and copper lift the way that they are, because I think it's a flight to safety and some level of protection. And then you would say to yourself, well, then surely with prices coming down, the consumer must be feeling much better about themselves. Aha, not so fast. 68.5 versus 66 consumer sentiment. They are in fact not feeling warm and fuzzy about the market. 69.8 versus 67 consumer expectations of if they're going to feel warm and fuzzy or down. And the current conditions are not warm and fuzzy with a 66 to 64. This is the big dog. That's why they highlight it in red. Now, but interesting statistic, and I'm not saying this for political purposes, but understand that no president in history has ever got elected when you have a number like this. What they want is they always try to cut ahead of it. This is why you've seen so much pressure to cut, right? Because if you cut, then this will spike up. What's fascinating to me now is that Powell's going to once again wait too late, like he waited too late to stop raising rates. He's waiting too late to cut rates. And that's my personal opinion. Now, just so you can see how the world feels about the consumer and how the consumer looks. So this is dropping right in line with what? This is dropping perfectly in line. In other words, prices are dropping because the consumer's not feeling really good about themselves. So this continues to drop, and it's a very different landscape than when they were cutting prices back here, and all of a sudden you had this peak when everything's good. Yeah, they're dropping prices, we can afford things. And now, not so much. This is really important to watch, and that explains this. This data will have more significance this week than probably has had all year. You always see moves of retail. This week, they will be watching retail sales. Absolutely watch retail sales. Forget about the export prices. You can watch them, but it's all about retail sales. Are they buying? Are they not buying? This can actually move the market on Tuesday and have the same effect that you've seen as a CPI release right now. See, this is why it's so important to get that whole stool concept, because when you understand that right now you're leaning on the macro the most, and you understand that the data point is not CPI as much as retail sales right now after that data, because you have two conflicting pieces of data. You have the CPI release and you have the PPI release. Okay, this is really important to get. Now you understand why we had what happened on Thursday to some extent, and quite frankly, it was much more significant than I thought. And this will happen on extreme moves. So what you have is a standard deviation move, or what they refer to as like a sigma 10. I'll show you the chances of this happening in a second. So if you try to build a metric around this, it's not gonna, it just happens to you. And this is why people that own tech stocks got clobbered, or they just didn't see this coming. And let's be honest, if you own tech stocks on Thursday and people are telling you they didn't have a drawdown, they're just not being truthful. There's just no way around it. You're gonna have drawdown. So here you are and you're dropping, and then you're realizing that, okay, well, the last time this happened was right around election year. All right, fine. Is that the reason? No, the reason was the data that we just went over. It's also why you're seeing certain sectors rally, and we are gonna go over that in some detail because there's a lot here based upon what we just went over and the shift, and some of the shift's not gonna go away. All right, so then if we look at this and we can see that that's an anomaly, How big of an anomaly is it, and how's it going to affect us? Actually, I misspoke. It was a standard deviation of 6. I don't know why I said 10. But once every 506 million years that happens. This is from the market error. The small cap's outperformance of large cap was a 6 standard deviation event that should happen once every 506 million years. However, we don't get too excited. There are an infinite number of 6 sigma events that happens, the possibility of a specific event happening once, but the probability of any happening in any day is far, far less. It still happened. Now, this is what we need to focus on next, because this is really where it gets technical. This topic is, they have a real nice way of saying it, and this is pretty true. They call it the echo death. So what they're really getting at here is that these are traders and they have a P&L, right? And they only die when things revert back to normal. Essentially, they save themselves by going long the transient unwind factor and then blow up later. Friday, similar to Thursday, the pain will be far higher. A lot of people are taking the pain and hoping this doesn't continue. There's two, and obviously this is whose research it is. There's 2 schools of thought here, and this is what happens to people. They will sell tech, and then they'll go long the Russell, okay? And then they'll not understand why they did what they did. All right. And they're just trading it and not understanding why they did what they did. And then there's people that will not sell tech and hold their positions and not understand what happened. Either way, these people just bleed. Because if you sell tech and you buy the Russell and you don't understand why you did what you did, you have a major problem. And now with what we just went over, you understand why you did what you did. Right? You would understand that this is because of the easing. But if you don't get that, then when they start to revert, you're just going to blow up your P&L again. That's what's going to happen to people. And this is a really important concept to get. Let's take a look at some charts. And I want to review the one indicator that really changed on short-term and long-term. Now, we've heard a lot about overbought, oversold, specifically when it comes to the NASDAQ and the S&P. Now, I found this fascinating, so I wanted to share it with everybody, because sometimes we look at these numbers and then we just don't really understand what we're looking at when we really dive into them. What I mean by that is, this is the S&P 1500, which is obviously larger than the S&P 500, and this is more encompassing of everything going on out there. What we'll note is when there's this level in January, and we'll see these peaks in January, and the spikes. And what this will tell you is percentage of stocks in the S&P 1500 that are above 70. And what we'll see is that clearly marked some level of a bottom where you just kept lifting and lifting and lifting and lifting. And eventually you sold back down. And now this is where we're at right now. But what we'll see is we'll see this huge move that happened that led to this. And sometimes you'll see that, but there's a precursor to this. And I'm going to show you what the precursor is in a moment. Now, what's so interesting is this is where you're at. You're not even over 10%. So 10% of the names in the S&P 1500 are not above their 70. But when we look at the NASDAQ, we're seeing a level that is substantially higher. And what does that mean? It means that a select few names have gotten ahead of themselves, and that's where we're starting to see some pressure being applied to the market. Now, with any data whatsoever, multiple timeframes helps, because it just shows you, and they refer to this as their demarcation line, and we can see where we're at, and we can see how this demarcation line was going sideways and how it started to lift. And the one thing that we can see very clearly from here is that when it lifts in any direction, whether that takes a slow turn or a big turn, no matter when this happens, the underlying SPY does what? It goes higher. So as long as the trajectory of this is going up, which it is right now, the S&P goes higher. And what this leads us to believe is going, okay, well, do we have some kind of demarcation? And what do I mean by that? Are a select few names the possibility of going down, i.e. the mega tech and the momentum names, and some other names are going to start going up, and we're not going to really understand why the S&P is going higher or going sideways at the same time, because we're going to expect the tech names to drop, right? So this is, just stay with me, we're getting to it. But if we look at this, we're clearly seeing that when this rises on this year, the S&P goes higher. That's objective. And just to really get in there and look at the last 3 minutes, or 3 months rather, you can see, yep, you're at that 2.5 level, and then all of a sudden we're at 7.5. So what does that mean? Well, that means in the month of July, you've gone from 2.5% to 7.5%, or you really have gotten to the point where another 5% of the S&P 1500 are now above their 70-day moving average. That is a lot of names in a very short period of time. It's actually even faster than what we saw here, and I think that this is important. Now, there is a shorter-term trigger with the same kind of metrics, and I want to just walk through what we're using here. Again, this is from Sentiment Trader, but what we're doing is there's a construction of the way that this is done. It's the percentage of the S&P, the RSI on those 1500 extreme indicators that are calculated by determining the 2 and 14-day RSI values. And that's what we're going to do next. We're going to look at the twos. of the 1,500 symbols in the S&P, and then you determine percentage. It's supposed to be percentage. They spelled it wrong. Should have picked that up. And that you're looking for those extreme values over 70. Now, this is where I think it gets pretty interesting because here's 3 years out. And if we just take a look at the 3 years out, you can see this red, but I'm just going to make it absolutely glaring for it. And if we look at every single sector that you're in here, and what we'll do is let me put that on pause for a second so that we'll pause that line. And then what I'm going to do is just show you this way. So if I go to here, and this is obviously where we had the peak of the market, it's a tough spot to use, and you can see all these in here as well. But if you look at these little levels, they'll tell you one thing on the short-term indicator. You certainly didn't go down because, I'll just mark that one off, but you certainly didn't go down because you had them. I guess we can circle that one. We don't want to really leave it out of the way. You didn't see this indicator and then miraculously drop is what I'm getting at. And I think that this is really important, and that's over 3 years. So again, here you are, and you can see it, and these two obviously are included as well. But what are we saying? Well, if we go to this particular level, over, which is where you're at, you can see how extreme that level is on a 1,500 RSI 2-day. So then what you could do is go, okay, well, I only want to look at those levels. So what the easiest way to do that would just be to come here and then just clean all this off. And then we can just kind of start over and go, okay, well, I only want to look at those levels. So we're only going to take a look at the levels that combine exactly with the highest reading that we have right here. And that's going to give us a smaller demographic. So what we'll do is we'll just mark them off real quick, and then you can kind of see where we're at. And what we're looking for is those extreme levels over the past 3 years. Now, if you're going to look there, is that going to tell you that you have to buy? No. Absolutely not. Is that going to tell you that you have to get out? No, it's going to tell you that in most cases, even here, it was telling you that, hey, we're pretty much near a bottom. So I find the reading fairly interesting. Now, on a yearly basis, when we just break out the year, let's do it this way. Let's clean it off and we'll start fresh. Sometimes you're just better off looking at a fresh chart. And I'm going to mark it here. And all I'm doing is, hey, do we ever have a reading all year that was anywhere near here? And the answer is, well, that line's really crooked. Let's make that straighter. How about that line? Is that a better line? I think that's a little straighter. And what we're looking for here is there anything in here that tells us exactly what happened? And then you could kind of say, well, yeah, I mean, we could say that something like right here did. Yep, that definitely told us here. Okay, how about this? Yeah, I mean, you're right there as well. And then you could even say, well, these kind of did as well. All right. Is there anything about this that's telling you that you have to get out? No. What I think it's telling us is that there's a certain sector that is completely overbought, or a certain subsector that's completely overbought, and we're seeing it kind of frantically move throughout the market. And then there's another sector out there that has about 1,400 and let's call it 90 names in that are actually ramping up and setting up to move a little bit higher. Now watch what happens when we get even tighter. When we start looking at this just over a year to date, which is really what we did here by just saying 6 months, what are we seeing? Well, we're seeing that we really only had like one reading that was even close to it. You say, okay, well, what happened during that reading? Well, if we look right here, and we look in this area, even if you just took this whole area, and took this whole area, well, this marked the bottom. It didn't mark a top. And that might be why we saw the action that we're seeing this week, where it looked like we were going to sell down, but we really didn't sell down. It was just a group of stocks rotating out as we rotated into others. And I think that's an important distinction that we're going to have to pay attention to this week. And I think this highlighted it pretty clearly. Now you can see one of the key things you should be focused on this week, in my opinion, is RSI. If we take a look here, you can even see names that are interest rate sensitive. And I'll show you how you could tell that this was coming when it started in a moment. But if you look at these kinds of names, all of a sudden the volume's going to be through the roof. Everything's going to start moving. You're not going to understand why. Names like Affirm, a lot of people are not going to understand why. Names like Affirm could actually start moving again. This is kind of what you want to start thinking about. You have the interest rate side of the equation, and we know that that's consistent. And let's define what we know by consistency. So in other words, when I say consistent, rates are only going to drop. We know that rates are only going to drop. It's no longer debatable whether or not rates are going to drop. The question becomes, is it going to look something like this, or is it just going to be the Fed realizing that they made huge mistakes and we just see tons of them? So if we know that with certainty, that is objective. It is no longer up for debate on what they're going to do. They're going to cut. How many times, and then how many times they're going to cut, and then how fast the cut, that's up for debate. But the trajectory is no longer up for debate. And you're welcome to comment on that, but I don't think it's really even a debate at this point. So understand that. And then what we have to do is we have to go, who benefits from that? Well, it's anybody that's interest rate sensitive. It's anyone that borrows money, right? So then, okay, well, Who borrows money? Well, I'm glad you asked. So then you would go and take a look at those sectors. For example, KRE. Now, KRE has been completely beaten down, and this is the regional banking sector. If we take a look at this and we look at the breakout, well, did this break out yet? No. All right, well, what do we know? Well, here's the RSI, and the RSI is pushing. Is this a place that you want to buy it or not buy it? That's up to the individual and what they want to do, right? That really depends. Do you think you're going to get through? Do you think that there's certain banking stocks that you might want to look at versus others? I do. I have some names that I'm very interested in, but if you're looking at it from a group perspective, the easiest trade for us on Thursday was just to go out there and buy this. I mean, this is the 3X ETF. And to me, I think that this was even being a little bit telegraphed on Wednesday, but you can see Thursday just exploded. And then Friday, we even had follow through. Now, Friday, at the end of the day, a lot of these things sold down. But I don't think that's as big of a deal as people make it out to be. So you want to start looking and saying, okay, who's going to benefit from this and the fact that we're going to cut? And that becomes very clear. So we've been hearing about the death of New York office real estate forever and a day now. And then back here, if you've been following these videos for some time, it was actually back here on this day where it was about a year ago where a Japanese firm bought half of 245 Park for $2 billion. Right? Since that happened, this stock is up 100%. It's stocks like this that you don't lose a night of sleep over. Right? That you just understand that this is the trajectory, this is how things are going to go, therefore this is going to get better. So for me, looking at first tier office space in New York, where everybody thinks New York is dead, until you go and try and buy a home in Manhattan, and then let me know, you go and trying to rent something, then let me know how dead it is. And then you just kind of see what's happening here. VNO and SLG, they're setting up to break out. And you're seeing this across the board. Now, I'll tell you why, and you can see XLRE because of earnings, or I'm sorry, because of interest rates. Now, I'll tell you why I would focus on office space versus any other sector. And this is something that I think is really important. Some people would say, well, I'm going to go buy the malls. Well, you're going to go buy the malls, and then at the same time, you have some issues going on at the malls, don't you? Because if corporate profits are down and people lose their jobs, then what's going to happen here? Then retail sales, which we're going to go watch, remember previously, they might not be as good in the future. So that might lead to SPG not doing as well. If you have a weaker labor environment and somebody says to you, you need to start coming into the office again, you're going to drive your butt into the office again because you're going to need a job. And that has been lost here in this economy for some period of time. And so you're going to see the resurgence resurgence is a better way of saying it, of the office space again because of a weaker labor market. People don't think it's coming. It's coming. And I would focus on the first tier side of the labor market is kind of where my head is, and that's New York. I wouldn't look at second tier stuff like even though Philly, if you take a look there like BDN, yeah, this stuff's moving, but do you really want to bet that the second tier stuff's going to move first, or that people are going to go back to San Francisco? There's too many people that are heading out. You could go look at something that's focused on Texas, I guess, but I would just focus on New York because that is obviously where the majority of global money is going to. And then I would not be looking at apartment REITs either. I would stay focused because they're going to have some issues when rents drop, which they are going to drop. So that tells you the XLRE. And that also tells you why you should be looking at something along the lines of, the regionals, right? All right. And then if you take a look at that kind of stuff, you would say, all right, well, what else is going to benefit? Well, the biggest problem that you're having right now for home builders is not lack of demand. The biggest problem that you're having for home builders is what? The biggest problem home builders are having is that the mortgage rates are too high. They have demand. People can't afford them. The affordability index is just, it's a disaster right now. I'm not going to get into all of it, but it's an absolute disaster. And that's based upon that they've raised rates faster than any time in the history of this country, period. And they did it so fast that people thought that they were going to get a 3.5% mortgage, or now looking at a 6% mortgage. And the people that were building homes for, let's say, a 4% mortgage. So eventually, as mortgages come down, people are going to buy homes, okay? Because they're not going to want to rent. And so the affordability index will drop. And that will lead to what? People buying more homes. Okay. And so that's going to help the home builders. So those three sectors really benefit greatly. The other group of names that are going to benefit substantially are going to be places like Ford, who has a tremendous amount of debt. And now they have to refinance that debt. GM, who has a tremendous amount of debt. But who else is really going to benefit from this? And let's say that Trump gets in with the tariffs, and all of a sudden domestic cars look a heck of a lot better when someone goes to buy it than a foreign car. if that happens, right? It's a wild card with it, but it's still there. But the amount of debt that they can refinance, it's there. And you're seeing a shift, and this is an easy way to see that shift. Now, in front of us is just the heat map. And I have the heat map set up as breaking it down by sector, and then by performance, and then by volume on the day. And we're just going to take a snapshot of Friday. And I just want to point some things out, and then I'm going to show you how I would drill into this to look at what the heck's actually going on under the hood. The one thing you're going to notice is you are seeing a huge move here in finance taking center stage. Now, you could say, well, NVIDIA was pretty aggressive. Yeah, it was. Intel's getting some love. Apple, yeah. Watch when you just take a step back and you just start getting rid of some of these. So in other words, if I just click on this and get rid of the zeros, and then I get rid of the 1%, and then you just start looking and saying, okay, well, who had the 2% or greater moves either to the downside or upside? And you start seeing a pattern developing here. Now, to me, I think it's a pretty obvious pattern, but you're seeing the cheaper, in my opinion, semis getting bought. So Intel, they're going after. You're seeing some Micron, which is very cheap considering where it was. Even SMCI had some love, and you're seeing NXPI. And you're starting to see ENPH get bought too, and some of the solar names. Why? Interest rate sensitivity. Really important to get that with the solar names. Okay, you're seeing ADI again, which is more of an analog company. All right, but what are we not pointing at? Well, we're not pointing at Wells Fargo. We're not pointing at Citigroup. We're not pointing at BK, which absolutely crushed. Regional banks set up properly that absolutely crushed. All right. So then you look at this and go, well, now Ford's moving, GM's moving. Well, you're telling me that out of all these names, the ones that we're going to be looking at the most are Linear and DHI, home builders, PHM. All right. It doesn't matter which of these you play. I like playing Toll Brothers. Maybe I don't know why I do, maybe because of their highest end, per house. But I'm just partial to playing that one. But any of these names look great. But Ford and GM are all of a sudden getting center stage. And then you zoom out on this. All right, Tesla doing Tesla things, Ford, Linear, DHI, Wells Fargo, BK, Intel, Micron. Well, where are the big dogs? Where's the Magnificent Seven in this? Okay, well, here you go. Meta down 3%. So it's telling you, it's literally showing you in objective form what's going on ahead of earnings. And you're going to have a wild earnings week. Now, in front of us is a trade that we did in the community on Thursday. And I want to highlight this one specifically for a couple of reasons. One, it ties together everything I went over. It ties together, and I know DPST, it's not as sexy as me pointing out and shorting Tesla at the highs, but you have to understand that the goal is to make money. When you're seeing this kind of stuff, what you want to do is you're looking for pattern recognition. And this is a really simple. You already know where the money's going to go. You already know it's going to go into regional. And then you just kind of come along here and you're marking off this bar, and you're marking off the high of the first 5-minute bar. You see it test. You see the bearish engulfing here where this body encompasses that body. You see the rejection here where all of a sudden, see how these are starting to go up and up. I should actually do a video on this one. It was actually pretty good. I have another price action video. It's going to be released this week. But we did the one. I'll link the one at the end of this as well. And it's literally step by step how I do this. I slow it down and then show them live. But if you look at this, and you watch the rips, right? And you watch the pushes, look how they're getting lower and lower. We know that this wick is a price rejection. And then when you step into that, you know that there's an issue there. And then what you're doing is you're just getting out, right? And then pushes and then pushes. And then eventually what do you do here? You flip. And then from that flip right over, see that close over there for the first time? You don't have one of those. All I need to do is buy right there, and you can see that that's where I'm saying that I bought, and then I'm just really using that wick. And that gives me a much lower entry risk than just saying I'm going to buy this and then just, spraying and praying and hoping. In a day trade, I day traded this in an aggressive account. And even in that day trading account, I held a piece until Friday. I should actually show that trade because it was pretty interesting to see how you can hold some of these things overnight. Actually, I'm going to show this trade in a second. But also, I still have a piece of this because I don't think that there's any really way that regional banks don't continue to rally. I think it'll be a slow mover, but I do think that it'll continue. Let's take a look at this trade. And then I want to show you something else that you need to watch on the week. Now, this is a relatively simple trade, but most people are going to look at this and say, oh, it's a flag break. It really wasn't. It was what I walked through before and how tight and how it popped its head over. And what I'm doing here, like watch, if I go to this on a 5, you'll look, and you'll think, okay, well, there's the flag. What you're doing is you're making sure that you're getting over that particular level. And then once that happens, then it's on. I actually fired into it once, made sure it held, and then like a second later or a minute later, I fired back into it. But I knew it was something that I wanted to hold. So what I did was when it traded up from here, what I did was just as soon as it went up, I'll show this on a 1. And I do think this is a really good one to show, because a lot of what I'm hearing too from people is they're not able to stay in. So when I got involved here, up, first sign of weakness, and I sold half right into that. It's a 3x ETF, they're all over the place. And what this allows me to do from then is all I do here is I just constantly am just reassessing. I'm not telling it what it's going to do, but once I do that, that's your first demarcation line. Your next demarcation line is just going to be the lower low, right? So this is where I sold, and then you wait for the lower low to establish the high, and then you're watching this for the rest of the day. And that's really what I'm doing. And then I'm just watching these levels establish and saying, okay, do I need to do anything with the rest of it? And the answer was, no, I really don't. And again, you're just watching them establish, because if they start to crack like here, you might say to yourself, okay, I need to get out. And that's not what happened. You can always just close it at the end of the day, but I was trying to stay in some of it. So by cutting a big portion first, like half out, it just allowed me a lot of flexibility. Essentially, if I honored my dollar stop, the trade was worst case break even, and that's not a bad spot to be because you're always trying to manage risk. But at the end of it, what I did was I waited for the gap up, which we got the next day, and then I sold half of the remaining, and then we rallied, retested that level. It's always important to leave previous levels that you've drawn on the next day. It's always important to leave previous levels that you've drawn on the next day. And then as you rallied up, right, I'm like, okay, I'm super smart. And then it came back down. And then as soon as it broke that low where I got out before, that was enough for me to just get out of it. Usually on these kinds of trades, that's what I'll do with them. I'll blow them out. Now, I want to say something. This to me is a day trade that turned into an overnight trade. For a swing trade position, I actually added on this day. So it's really important when you look at me showing you these trades, understand my perspective on entering the trade and understanding why I'm getting in, why I'm getting out. And this has nothing to do essentially with just, I want to be in for interest rates. This has to do with, yes, these names are going to move today and I want to pull some money out of the market. It's a very different distinction. Now, what I want to give you is a framework. And the framework that I'm going to give you is going to allow you to get edge on people. I'm going to show you how. So in this, right now I have set up IWM, I have the SPY, and I have the Q set up. I would put these, if you're using TradingView or whatever you're using, I would put these in line form and I would just be using a 5-minute chart. And what you're going to see is you're going to see a massive shift. And you can see when you saw that shift right here, right? And then you can see even as these took out lower lows on the day, what never happened here? The IWM didn't do. So when people are thinking that this is going to revert, does it look like it reverted? No. But there's ways to determine if it's going to revert or not. By putting in other sectors that are moving, the sectors that we're rotating into, and these are the ones I'd put in, and I'd actually put this in as well. And I'd put some big names in here as well. By looking at this, you're going to get a better sense of what's going on in the market. And what this can do is it can lead to a couple things depending upon your time frame. You could go to a 1 minute on this and say, okay, what's going on? And what you'd want to do is you'd want to move the data point. So in other words, here's Wednesday. So you'd want to go to Thursday when this happened. That's when we saw the shift. So you always go from the shift on. And then from that point, what you do is you drop a demarcation line. This is really important from that spot. And it doesn't matter where you are. In other words, it doesn't matter if I do this over and then say, okay, well, from here, that's where we're at. It doesn't matter where the chart is, but just drop a demarcation line down and then over, right? You could set it as a zero line. It doesn't really matter. You could put it at right at zero. It doesn't really matter. What you're looking for is you're looking for rotation. And what you really saw here and what this will show you is very simple things. Well, everything sold off at the end of the close Friday. So people just wanted out of the market. It was not like one sector. But what it will show you, and this is why I think it's important to put the big dogs in here. What are they selling? What have they begun selling? Well, they really, since this time, they're getting out of Meta, they're getting out of NVIDIA, they're getting out of Microsoft, and they're getting out of Amazon. What sector are they getting out of the most? And then if we laid all the magnificent 8 or 7 in here, however you wanted to do it, you could look at Apple and say, okay, well, out of all of the big dogs, what's the one that's holding the best? Apple. Okay, if we are to rally, which one should we go and take a look at? Apple. Now, some people will say, well, why wouldn't you buy the one that's down the furthest? Well, the one that's down the furthest is the one that they're selling, right? And then if you're trying to figure out of all of this where you would put the money or where's the money really going, it's very clear. You would look at the index, right, that is leading from this, and then look at any sector, please listen to this part, any sector that's beating the index. So you would look at which index is beating the market, and then you would look at any sector that's beating that index. And that's going to tie you right in to the regionals, and it's going to tie you right into the home builders. And you can do this for any time frame. A great spot to do this might be Tuesday in the retail sales. That's it.